Good day everyone. We are Group 6 and for today's presentation we will be discussing about the hybrid financing with its subtopics preferred stocks, leasing, warrants, and convertibles. Allow me to introduce you the reporters, Norin Paicana, Rachel Ridao, Rochelle Escano, Angelica Abad, and Henry Salbid. This is the presentation outline. First, the basics of hybrid financing, advantages and disadvantages of hybrid financing, types of hybrid securities, preferred stocks, leasing, warrants, and convertibles. So, introduction. The hybrid financing definition includes characteristics of both debt and equity, two ends within the financial spectrum, in order to provide financial security. Hybrid financing is where debt and equity meet in the middle, offering investors the potential benefits of both. So, how equity and debts involved in hybrid financing? Equity gives the right to have a residual claim on the cash flows and asset of the firms and have control over the management, whereas the debt represents the fixed claim over the cash flows and the assets of the firm, but generally do not give the right to control the management. The purpose of hybrid financing is to offer the investors the combination of positive factors of both the debt and equity instruments. Equity instruments give the sense of ownership to the holder and a residual claim over the cash flow, while the debt instruments are issued to raise capital in the firm that could be used in its development. So let's go to the next slide. The advantage and disadvantages of hybrid financing. Aligned with the positives and negatives associated with debt and equity, the risk is arced into any investment regardless of type, but the benefits includes access to cash and assets connected with both equity and debt for investors. For the organization, hybrid financing can provide regulatory or tax benefits. So, advantages: higher yield, less volatility, and diverse nature. Higher yield. Hybrid securities are generally placed subordinate in the capital structure and hence offer a high rate of return than senior debt. Less volatility. Hybrid securities have less volatility in the market because they pay regular, predetermined distribution of market returns. Diverse nature. Hybrid securities are, as mentioned above, not bound by any strict definition of either equitable securities or debt securities, and hence can diversify the overall risk portfolio, while again guaranteeing attractive returns and hence improving the firm's risk profile. In disadvantages, hybrid financing is considered complicated because investing through hybrid securities is considered more complicated than investing through equity or bond securities. So that's all for my report.
Good morning everyone, I'm Angelica Abad and my topic is preferred stock. Preferred stock are share of stock. It gives its holders certain privilege that make them senior to common stockholder. They have preferred stock over common stockholder with respect to distribution of earnings and also earn a fixed dividend payment. And questions: is preferred stocks or debt or an equity? A preferred stock is a hybrid security, is a hybrid of debt and equity, and it's similar to debt in some respect and to equity in other ways. In the accounting perspective, is classified as equity, therefore it is shown on the balance sheet on equity account. However, in finance perspective or preferred stocks lie somewhere in between debt or equity. Debt and equity and imposes a fixed charge, so it increases the firm financial leverage or value. But removing the preferred dividend does not force a company into bankrupt. A lot of preferred stock are said to be a cumulative future. It is a protective future that requires preferred dividend previously not paid before any common shares dividend can be paid. Therefore, cumulative preferred stock shall be paid first before the shareholders receive any dividend. This dividend, if unpaid, are called arrears, which accumulates until it is paid. Another type of preferred stock is a preferred stock that is adjusted regularly, and this is called adjustable rate preferred stock.
Good day, I'm Rochelle Escanio and my report is all about leasing. Leasing is a contract by which one conveys real estate, equipment, or facilities for a specified term and for a specified rent. Lease is a contract outlining the terms under which one party agrees to rent an asset, in this case, property owned by another party. So, it has two guarantees. First is lease and lessor. Pag sinabi nating lease, it also known as the tenant or who used the property. And lessor, the property owner or the landlord who regular payments for a specified period in exchange. For example, pag magre-rent ka ng apartment, may sinusunod or may tinatawag din dong contract outlining. Sabi ko nga kanina, ang contract outlining is terms under which one party agrees to a rent asset. So, may agreements na pinagkakasunduan sa contract outlining nito, like rental amount, kailan babayaran, rules na dapat sundin, etc. So, lease is legal and binding contracts that set forth the terms of rental agreement in real estate and real personal property. Pag sinabi natin real estate, it is considered also a real property that includes land and anything permanently attached to it or built on it, whether natural or man-made. So next is merong example of residential property lease. First is the property address, landlord and tenant responsibilities, the rent amount, a requirement security deposit. Pag sinabing security deposit, it measures the security for recipient and can also be used to pay for damages or lost property. Next is rent due date, consequences for breach of contract. When we say breach of contract, it is occurs when one party in binding agreement fails to deliver according to the terms of the agreement. This contract happens in both written and oral contract. Next is the duration of the lease, pet policies, and other essential information. So in leasing, we always remember that the landlord and the tenant should retain a copy for the lease for their records. This is especially helpful if and when any disputes arise. So this is all my report about leasing. Thank you.
Good day everyone, I'm Rachel Ridao, and my report is all about warrants. A warrant is a certificate issued by a company that gives the holder the right to buy a stated number of shares of the company's stocks at a specified price for some specified length of time. In other words, a warrant is a long-term option, a given stock at a fixed price. Corporation may issue a warrants that allows you to buy a company's stocks at a fixed price during a specific period of time, often 10 years or 15 years, though sometimes there is no expiration date. It is generally used as an incentives to investors to accept bonds or preferred stocks that will be paying a lower rate of interest or dividends that would otherwise be paid. So, how do stock warrants differ from stock options? Like a warrant, a stock option is a contract that gives the holder the right to buy or sell stocks at a certain price over a specified period of time. Though options and warrants are similar, they are used in different situations for different purposes. Warrants and options both offer investors an opportunity to gain exposure to a particular stock without requiring them to purchase shares. On the other hand, warrants and options also have important differences. While companies issue stock warrants, traders typically buy and sell options with each other directly. Warrants create new shares of companies, while options do not cause any dilution. Here are the two distinguishing factors. Number one, they are used to different parties. Companies generally issue stock options to service providers such as employees, advisors, or contractors as a compensation or as an incentive to stick around longer. Warrants can be issued to service providers too, but it's less common. Instead, companies primarily issue warrants to investors, banks, and third parties when entering a commercial or financial transaction. Number two, they have different exercise prices. You have to set the exercise price or purchase price of stock options at the fair market value, one of the share at the, at the time you grant the option, regardless of how much your shares go up in value over time.
Good morning, everyone. My name is Sandra Arsalbid. I discuss to you about convertibles. What are convertibles? Bonds or preferred shares that can be converted into common stocks are known as convertible securities. Most frequently, convertibles are related to convertible bonds, which let bondholders change their status from creditor to equity holder a predetermined price. Notes and preferred shares, which can have a variety of characteristics, are examples of other convertible instruments. A convertibles is a bond, preferred share, or another financial instruments that can be converted by the shareholder into common stocks. The importance of convertibles is predetermined amount of money in interest. They have two types of convertible bonds. The first type is vanilla, the most basic type of bond that provides the option to convert equity share. Second is mandatory. This type of convertible bond will automatically convert by a certain date.
Thank you for listening, and this is the reference used in this presentation. You can access and view the full details or documents of the following topics in these links.